Capitulation is the action of surrendering or ceasing to resist an opponent or demand. Last week, the market rallied, and there's a lot of people out there right now that are saying that the bear market has capitulated, that the bear market has surrendered, that it's over. And the thing about bear markets is they have this way of tricking you. The market rallies, you think it's capitulated. Oh, let's run this baby up. It's ripping, it's ripping, it's ripping. Oh my God, no. And what you thought was capitulation, unfortunately, ends up being a bear market rally, which is a sharp short-term rebound in share price amid a larger-term bear market decline. Bear market rallies are also known as dead cat bounces or sucker rallies. And so what is it? Because there are smart people on TV right now that are saying the market's capitulated and the market's going to rip to the upside. Our troubles are behind us. But then there's some other smart people on the other side of the coin that are saying this is a bear market rally and times are going to be tough in the next few months still. And so let's figure this out. Let's see where we are right now, where we stand if this is a bear market rally and where we stand if this is market capitulation. So let's go ahead and let's get started. Thanks everyone so much for watching. I do want to remind you I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence. All right, so quickly before we move on, I do want to mention that I have some affiliate links below in the description. Take a look down there if you want to support the channel. Specifically, I have a link to Barron's newspaper. So if you're interested in market news, Barron's newspaper is a really great publication that comes out weekly that's only about investing. So take a look at that if you're interested. And also, of course, like and subscribe. So look, I wasn't always a market watcher. You know, someone who really pays attention to what goes on daily, does technical analysis, really cares about movements in the market in the short term. I was never that person. I was what I consider to be a value investor. I only cared about fundamentals of companies. And that's what I focused on. And I really didn't care if the stock market was up or down. I was just looking at what I thought the company was worth. I still do that. I still only buy stocks that I think are undervalued, but I now utilize some other little things because I'm now kind of a market watcher, and I do some technical analysis, and I do care a bit about where we are inside of the cycle. So to keep up with all this stuff, I'm constantly on Twitter, which is an amazing place to find content about what's going on right now. If you follow the right people, FinTwit is really amazing. And so I came across this chart the other day by Callum Thomas. What this is showing us is whenever there was a 6% or more weekly gain in the S&P 500 index, what happened to the gains 3 months out here, 6 months out, and 12 months out? And we're paying attention to this because in March 18th, the market ripped 6.2% in a week, and then it did it again just last week, the 27th of May. It was up 6.6%. And so what we can see here is that in other time periods when this has happened, the average only 3 months later was a 5.6% gain. The average 6 months later was 12.5% gain. And the average a year later was a 21.7% gain. And a year out, 19 of these 23 different time periods, the market was up. So you would have gained money. So essentially right now, you have a good shot looking at historical data, which of course past performance is not indicative of future returns, but looking back, there's a good chance that the market will be up over the next year. So when we look at things like this, we have to kind of put it into context and say, okay, are all of these similar time periods to what we are today? For example, there are two kind of red time periods here. So this one here in 1970s, right, which was a time of high inflation, high interest rates, similar to maybe where we are now, not quite as high interest rates, but high inflation. And after that time period, after June 1974 and then September of 1974, you could see a 6% and a 7.6% gain. Now from the June time period, after 3 months, it was down 22%. But after the September time period, it was down only 3.6%. We go out a year, we're talking up 22%, and then it was flat in the June period. So maybe this is more similar to where we are today, or maybe we're more similar to the dot-com bubble. In which case, in June of the year 2000, you had a 7.2% return in 1 week. But a year out from that point, it was actually down 14.2%. And then over a year later, in September of 2001, there was another 7.8% gain in a week. And you looked pretty good for 3 and 6 months, but then 12 months out, you're down 21%. And what's actually really interesting is you would have thought that 2008 was one of those time periods where this was the worst, but it actually wasn't. In 2008, in October and November, you had 2 giant weekly gains. And 3 months out, things looked pretty bad, but when you go a year out, you're talking a 7% gain and a 22% gain. So that actually looks pretty good. And so when I look at this chart, it makes me feel pretty good. It makes me feel a little warm and fuzzy and maybe a little bit happy about where we are right now. But then I also kind of revert back to a little bit of pessimism, and I think of something that I read the other day. And this was tweeted out by Lizanne Saunders, and actually this one really had me thinking for the past week, and that is the S&P 500 indeed escaped technical bear market after a late day rally on Friday. This is May 23rd. That's when the market went down to the 20% down level and actually touched that bear market territory. She goes on to say, but one difference today versus late 2000, which was a near bear, is that 26% of members trading above the 200-day moving average. Back in December 2018, it was 11%. And so what I think is that Lizanne Saunders is putting things into context here. Essentially what she's saying is 2018, where only 11% of companies were trading above the 200-day moving average, that is a lot less than today, where we have 26% of stocks trading above the 200-day moving average, which is basically telling me stocks potentially are still overvalued and they can still go down. And so let's think about that chart before and put this into visual perspective. I have a chart here. Take a guess what time period this is. Over this time period, the market's down 39.74%. So yeah, I'm sure you guessed it right. It's the year 2008. We're looking at the S&P 500 index. And these are some decent gains that we can see that 2 of these were actually in that chart we talked about before. This one was not, but look at this. In October of 2007, there was at least some positive sentiment. The market was at least in a short-term uptrend. And then from that moment on, it pretty much just continued to decline. Now, along the way, you can see that here in November of 2007, so just about a month later, you had a 5% up week. So we're talking a lot of positive sentiment for the market at that time. And it continued to go even higher, and then it hit a top in December of that 2007 time period. And so here we are in October of 2008, about a year after this moment. And if we zoom in a bit here, we can see these 2 time periods that we saw in that chart before. This is about over 11% gain in a week. This is October of 2008. That ended up, of course, not being the bottom of the market. We have another one up over 15% in a week, and this was in November of 2008, just a month later. So back to back, 2 months back to back, we had giant rallies in the midst of a terrible bear market. Now, where did it go from there? How long did it take to get to the bottom? So this is the bottom of that 2008-2009 giant bear market, Great Recession time period, and this was in about March of 2009. So as you can see, along the way, along that way down within this downtrend channel, you still had times the market absolutely ripped in week periods, as in 1 week periods where the market would go up over 10%, but yet it just continued in a downtrend that whole time. And so that's what I think we need to always kind of consider and understand what's going on right now, and not assume that just because there is a week here, a week there, where there's really positive sentiment and the market does end up going up a lot, that doesn't mean that the market is going to be capitulating. Not at all. There's a lot more that needs to happen to get it above that point. And some interesting things to look at here, where I turn on the moving averages for this. This is a 50-day moving average in blue and the 200 in red. And remember, Lizanne Saunders tweeted out before that 200-day moving average that she was talking about in 2008, where 11% of stocks were only above the 200-day moving average, where right now 23% of stocks or 26% of stocks are above that area. Well, look what happened right at that downtrend channel when this thing touches the channel. This is exactly the same time we have a golden cross where the 50-day moving average goes up above the 200-day, which is a bullish sentiment. And from that moment on, it really stayed above that 200-day moving average, and it went up a lot from that moment. It wasn't until over a year later where it went back below that 200-day moving average. So this is kind of what I'm saying. That 200-day moving average right now, it's not looking like the stocks inside the S&P 500. There's not enough stocks that are trading close to that moving average. It's just one example and reason why I don't think that the market is capitulating. The bear market has not capitulated. What does that mean? Well, at the end of the day, it doesn't really mean much to me. I'm still buying stocks. There are many stocks that are on discount right now. There are some great companies that have great cash flows that I think are going to be around a long time, that I think are a good buy. And there are other companies that I think are still a little bit overvalued, actually. And I wouldn't be investing in those companies because I don't like the valuation. At the same time, I don't love the technicals of a lot of stocks right now. I'm waiting for them to get closer to some type of breakout. I don't love buying stocks in downtrends. I like to see them break out a bit or hit some support levels or show me something positive that at least gives me an entry point. So what I'm doing now is if I like the price of a stock based on the valuation, I'll initially buy it. I'll have an entry into it. And then I'll wait to see what's going on technically. And as it hits levels that I like, I'll add more to it. That's just what I'm doing. It's based on fundamentals and it's based on technicals. I'm finding a lot of stocks that I like right now based on valuations that I think are cheap. I'm not finding a lot that I'm liking based on technicals. So I'm entering positions and I'm actually waiting to see if I'm going to be adding more to those positions later. I'm coming out with a video, probably the video after this. It's going to be about my strategy right now for investing. So please take a look at that when it comes out. And that is all I have for this video. So thanks so much for watching. If you liked it, please hit the like button, subscribe to see more videos like this, and watch another one of my videos coming up on the end screen right now.